Hello, team. Welcome, welcome, welcome. I can see a bunch of people coming on in, so great to have you guys here. Just going to give everyone sort of 30 seconds or so to come in. Just in the meantime, just while we're waiting for everyone to jump in, if someone could please pop into the chat and just let me know that my slides and audio are coming through. Okay, that would be great. G'day, Darren. I can see Darren in there. Yep, got a bunch of people. Thank you for that, guys. And also, just while everyone is sort of filtering in, everything looks perfect from Wojak. So thank you, Wojak. That's what we like to hear. Guys, as we're going through today, there's the chat box is there. If you got any general banter or chat, you can feel free to pop that into the chat box. If you've got any questions as we're going through, please pop them into the Q&A. If you're not familiar with Zoom, it's sort of in the menu there somewhere. You should be able to see an option for Q&A, and you can type your questions into through that Q&A box. That just makes sure as we're going through, you've got a question, you want to make sure that it gets answered and make sure that it doesn't get missed. And so as we're going through the session today, I'm happy to get a little bit off track if people have got questions about the stuff that we're covering. And then I'm going to circle back and I'm going to have some more time for questions at the end. We are going to shoot out the recording to the session off the back. You can see a couple of questions on there already about that. Because we're doing this event with the Sharesight team, that they are going to manage the sending out of that, and they're just going to get their marketing gurus into it in the back end. And so we'll ping everyone an email off the back of today, but the recording of the session will be coming out shortly after in the next sort of handful of days as well. Also, guys, we've got Prashant and the Sharesight team are sitting there in the background, and I suppose it's probably the right time to move on to this next slide to say that our event partners for today is the Sharesight team. If you're not and I know that there's a lot of people that have come over from the Sharesight users already, but if you're not already familiar with Sharesight, then you definitely should be there. Essentially a portfolio tracking software that gives you a ton of different tax reportings, lets you check all of your investments in one place, and they've got a ton of cool reports that can really help around some of the stuff that we're going to talk about today around cutting your tax bill, being aware of your tax, working into your tax plan as well. And so if anyone does have any specific questions about Sharesight or on tax reporting, you can also pop those into the Q&A box. Prashant, I reckon I can convince him, if we get enough questions, to jump on the camera and answer a few of those at the back end for today as well. Also, as part of this, this event is the first in a series of 3 events that we're doing with the team at Sharesight. And so we've been working away behind the scenes for the last little while. They were keen to put together some content that would help their users and their broader community sort of do better with their money, essentially. And so we've got today, we thought a great place to start, particularly given that it's July and the financial year's just finished, all about cutting your tax bill. But as you can see on the page here, we've got the 27th of August, we're going to do a session on how to replace your salary by investing. And on the 24th of September, we're going to deep dive into inheritances and intergenerational wealth. You can get around those events for free on our Eventbrite page, which I assume you're already sort of aware of because you're registered for this session. But all of the details are on there as well. So if you register, we'll keep you across it and make sure you don't miss out as well. But definitely you want to lock those in your calendar now, because we've got some cracking content coming up as well. Also, for anyone that's not familiar with Pivot Wealth and our content already, if you're into this sort of stuff, we do a heap of different content, events like this one on Eventbrite. There's also a bunch of content on the Pivot Wealth website and across socials. We've got a podcast called the Mo Money Podcast as well. So if you're into this sort of stuff, then check that out as well. Now, guys, before we get into the content for today, just wanted to, qualify this. I was never here. This never happened. But in all seriousness, guys, what we're talking about today is not advice. We encourage you to seek out advice before making big decisions. And look, just practically, if you're talking about, tax planning, tax strategy, some of these things are, they can have a really big impact on your financial situation over time. And so if you're making big decisions, generally you want to make sure that you've got your I's dotted and your T's crossed as well. Alrighty. So, guys, look, I thought a good place to start was talking about financial potential and how to maximize your financial position, essentially. And what I've found from the work that I've done with my clients over the last sort of bit over a decade, that there's only really 7 things that you can do to improve the financial position that you're in. You can, and I've got them all on the screen here. So you can spend less money now. If you spend less money now, you're going to have a bit more money left over. Then you're going to be able to, save and invest that money, and that's going to allow you to get ahead faster. You can also spend less money in the future, as in you can lower the target that you want to get to for financial security or financial freedom or whatever label you put on that, because that means that you need to do less because you don't need to end up with as much money. You can earn more money. And this is something that a lot of people don't think about anywhere near as much as I think that they should. But there's a limit to how much you can cut your expenses. There's no limit to how much you can increase your income, and earning more money means that you're going to have more left over for savings and investing, more that you can deploy, more than you can apply to tax strategies as well. You can invest for longer. And this is an interesting one that I think, we talk to a lot of people and they will say that they want to set themselves up for, financial freedom by 50 or 55 or 45 or whatever that is. But oftentimes when we really sort of get into it and sort of dig into that a little bit, what we find is that for most people, that they don't actually want to stop work altogether. People generally, enjoy what they do and or have things that they do enjoy doing, and are keen to sort of do those things. And so I suppose the point here is that if you've got a target to become financially free at a younger age, I suppose, but you don't necessarily want to retire, you could consider maybe pushing that out a little bit, because that's going to mean that you need to do less now, or that you can get there faster, essentially, as well. Now, pay less tax is the next one, and that's something we're going to spend a lot of time on today. Keep more of your income. That means that you can ultimately reinvest that money or use it to live your lifestyle a little more, or do some sort of combination. Another thing that you can do is to use more good debt. So debt to acquire assets, that allows you to acquire investments that are bigger than what you can get with your savings alone, meaning that so long as you choose good assets, then those assets will grow faster. And then you can take on more risk in your investing. So you could put all your money into Bitcoin or, penny stocks, or, the most specky meme coins that you could possibly find. Now, I'm definitely not suggesting you do that, so please don't rush out and fire up your favorite crypto platform or anything. But taking on more risk, it could work to get you ahead faster. It also obviously comes with more risk, and so there's a higher chance of you blowing everything up and suffering a bit of a setback. But that is another potential lever to be aware of as well. So essentially, these 7 things is pretty much an exhaustive list of the things that you can do to improve the trajectory that you're on financially. I suppose the point in terms of what we're talking about today is that paying less tax is really the only thing that's on that list that doesn't require you to sacrifice more, work harder, or work for longer, or take on any additional risk. Because if you can cut your tax bill, then you're making more of the income that you've already got, and then you've got more money left over that you can use to actually help you get ahead financially. And so that's why we wanted to start with this event. We wanted to start on how to cut your tax bill, because it's one of the least painful and most effective things that you can do to improve what you're doing with your money, where you're going with your money. But look, at the same time, it's not easy. We speak to hundreds of people every single month, and they're all talking about, tax is a major frustration, want to be paying less tax, paying too much tax, all of these things. But it's not as simple as knowing that you want to be paying less tax to just make this happen, because and there are, everyone's situation is a bit unique, but we've found that there's actually three key challenges specifically when it comes to cutting your tax bill. Excuse me. The first one is that the rules are complicated, that there's a lot of them. They're not always that easy to interpret. There's a few gray areas that you need to look out for. And yeah, it can be really confusing. The second is that there are unknown unknowns. So you don't know what you don't know. And you recognize, particularly with tax, I think more so than other areas of finances, people recognize that there probably are a number of things that they don't know, but they're unaware as to what those things actually are. And the final point is that getting good help around tax, great accountants that understand tax, but that can also speak non-accountant, is also difficult as well. And so it can be quite confusing. And what I find that for a lot of people, the result is that they end up stuck. And it's often that it's not like you get stuck doing the same thing that you've been doing in the past, but you're often stuck just doing whatever you've been doing, and essentially that means that you're not making the most out of the money that you already have. So what we've found is that there's actually three things that you need to get right, or three areas that you need to get right if you want to cut your tax bill and also just crush it with your money a little bit more generally. And these are the three things I got on the screen here. So your structure, strategy, and solution. So your structure, to break it down, is all about making it easy to save and making it easy to manage your money, and making it crystal clear how much money you've got to work with when it comes to actually your saving, your investing strategy, your tax planning strategies as well. And so that leads into the next element, which is your strategy. And that's all about understanding the different pathways that are in front of you, the different things that you could do to take you from where you are to where you want to be. Buy shares, buy property, do a debt recycling strategy, do some negative gearing, whatever those things are. And being really clear on your next steps and how it's all fitting together. And then the third one is the investments and the product solutions that you use to back up your strategy. And here, what you want is to be getting reliable, consistent progress over time. And importantly, that you're avoiding the downsides and setbacks and those momentum killing mistakes. Now, what we've found is that if any one of these three areas is missing, it ends up dragging down on the others. And you might be wondering, well, why are you talking about, saving and investing when it comes to, we're here wanting to look at tax? But the reality is that if you don't have a reasonably solid saving strategy, and you aren't clear how much money you've got available that you could apply to strategies to cut your tax bill, well, you're not going to know what options are going to be the best for you. And if you're not clear on the impact of, different tax strategies, negative gearing versus debt recycling versus, buying your own home or whatever those things are, then it's going to be hard to have a smart plan as well. And ultimately, if you don't have good investments, well, you're going to blow up your cash. And if you don't have any investments, then your money's not going to grow either. And so if one of the three is missing, it also doesn't work. That if you're good at good structure, good solutions, but no strategy, leaving money on the table. You don't have, you've got great investments and a great strategy, but no structure. Well, that's a problem as well. So they are all three, or each three of these areas are areas that you need to get right if you want to nail it with your money. We're going to be focused today much more on the tax side of things, but I just wanted to call that out to say that there's a couple of other elements that you want to make sure that you're nailing if you want to truly get to where you want to be from a financial perspective. Alrighty, guys. So we're going to shift gears a little bit and get into the tax stuff. I'm going to start with the basics here. And look, apologies in advance. I'm sure that there probably be a few people here that would already know, but I just want to start from the super basics, and then I'm going to build in complexity and then wind it into the strategies and some of the more complicated ones as well. I just want to make sure we're all on the same page in terms of the foundations. And so the first thing that you need to understand when it comes to tax and cutting your tax is that in Australia, we work under a marginal tax rate system or what's called a progressive tax rate system. What that means is that as your income increases, you pay a higher rate of tax on the new income earned in the higher tax brackets, essentially. The other thing that's important to understand is that you only get one tax rate. So you get one tax rate that applies to your income earned from all sources. That means your employment income, your salary or your paycheck, any commission income, bonus income, overtime, second job income, side hustle income, rental income on investment properties, dividend income on your share portfolio, interest income on your bank account, basically all of your income from all sources adds together to give you one number, which is called your assessable income number. And then that assessable income number is taxed as per the marginal tax rates in Australia. Now, in Australia, these are the marginal tax brackets. I've got them on the screen here. Basically, the first tax bracket is up to $18,200. And in that tax bracket, you don't pay any tax on that income. From 18,200 to 45,000, you pay tax at 18%. 45 to 135,000 is 32%, 135 to 190, 39%, and then above $190,000, 47% in tax. Now that tax rate includes the Medicare levy, just for anyone that's sort of wondering why that might be a bit different to something that they might have seen somewhere else, but that includes the 2% Medicare levy as well. And so basically, what happens with these tax brackets is that whether your income is $10,000 a year or $1 million a year, the tax brackets still apply in the same way. So if you earn, say, $1 million a year, you still pay 0% tax on the income earned between 18,200 between 0 and 18,200. You still pay 18% on the next bracket. You still pay 32% on the next bracket, and so on and so forth. And so that's something that confuses a lot of people as well. Now, what that means when it comes to cutting your tax specifically is that the higher your income is, the higher your marginal tax rate is, and the more valuable every dollar of tax deductions is. Because if you're earning, say, $40,000 a year, tax deductions, you're going to get a dollar of tax deduction is going to give you 18 cents back. Whereas if you're earning $200,000 a year, a dollar of tax deduction is going to give you 47 cents back. Both of them are good. It's just that as you earn more, that your tax side of things, the tax deductions become more valuable. It also means that as you're building your investment income, that ideally, like the way that I see it, and the reason that we're doing the next event in this series is replace your salary by investing, is that is the definition of true financial success. When you've replaced your employment salary with investment income, that means that you're then working in a position out of choice as opposed to necessity. But what a lot of people do is that they're working and they're earning a reasonable income, which is what allows them to actually save and build their investments. But then they're doing all of that investing in their own name, meaning that all of the interest income, the dividend income, the capital gains, and these sorts of things, they're all adding onto their income. And then you could just be paying more and more and more tax on top of that as well. Now, investing is really important and everyone should be doing it, but you don't need to personally own your investments. When you're investing, you can own investments through a bunch of different tax entities, and these different tax entities have different tax rates attached to them. Now, what I mean by a tax entity is essentially things like trusts, super funds, companies, investment bonds. These are all essentially tax structures that have their own tax file number and their own tax rules that apply to them. And so I've got a sort of a really brief snapshot on the page here, where if you're investing in your own name, then you pay marginal tax rates or MTRs. Whereas if you're investing money through your super fund, then the maximum rate of tax that you pay is 15%. And in fact, it gets even better in that in super funds, if you're investing into like shares and growth investments, they only pay capital gains tax rate of 10% if you hold the investments for 12 months or more. And so you can see that, if we compare the personal marginal tax rates of up to 47% with a maximum rate of 15% in super, you can see why super is so appealing. But obviously it comes both ways in that when you put money into super, it's stuck there until you can access your super under the super rules as well. So that's also something that you want to be aware of. The next one that I've got there is a company, so PTY Ltd company. So this is essentially where you can set up your own private company. Anyone can basically do this unless you're on some like government blacklist somewhere or something. And essentially, you can then invest under a company's name. And if you do that, then the maximum rate of tax that you pay is 30%, 30% on all income and capital gains. When you invest through a company, you don't get capital gains tax discount, but the tax rates are flat and significantly lower than personal marginal tax rates. You can also invest through an investment bond. These are a little bit more confused, a little bit more like a super fund, where it's essentially an investment account, has different investment options inside it. But with the key rules with a bond is that you pay a maximum rate of 30% tax on your income. But if you keep the money invested inside the bond for 10 years or more, you don't pay any capital gains tax. So it can create some really significant tax savings for investments that are sitting there for the long term. And then the final one that I've got here is a trust. And for trusts, the key rule with the trust, a trust similar to a company in that you can set up a trust and open investment accounts and even buy property and shares or whatever inside the trust. The key rule with the trust is that it needs to distribute that money to other taxpayers. Can be individuals, or they call it beneficiaries. And if you distribute to an individual, then that income gets taxed at their marginal tax rate. Or you can do things like even distribute to a company, and you're essentially capping your tax at a rate of 30%, which can be really powerful. And that's why a lot of people that are looking to build significant portfolios or significant incomes from investments, then they combine the private investment company and a trust structure together, and it can be a really tax effective way to do things. Now, to put this in context, I just wanted to give you an example here showing the potential tax savings that are up for grabs. So I've got an example. Think about that you're investing today, working towards building up an investment income of $100,000. If you earn that $100,000 and you're already sitting at the top marginal tax bracket, you're going to pay about $47,000 a year in tax on that 100 grand. Whereas if that income is earned under a company or an investment bond is the same, then the maximum amount of tax that you're going to pay is $30,000. And so you can see that there's a $17,000 a year tax saving that's up for grabs just by structuring your investments a little bit different. Now that's 17 grand that you can reinvest to grow your investments faster, or you can use, spend part of it to enjoy your lifestyle a little bit more, or you can do some sort of combination of the two. And you can see that if you're trying to, like aspirational and trying to build even bigger investment income, 200 grand a year, you're talking about a $34,000 tax saving. 300 grand is 51,000, and it just increases from there. And so this is a huge difference that you've got the same investments, you're getting the same growth, you're getting the same headline income, but the net income that you have available to you is literally tens and tens of thousands of dollars different just by having it structured in a slightly smarter way from a tax perspective. So look, I suppose with this, you can see that the opportunity is there and the opportunity is significant. Now, a lot of people think that when they're earlier on in their investing journey, that because they don't have huge portfolios, it's not something that really applies too much to them. But how compounding works is that you start slow and then it starts building up quickly. But if you don't have your structuring right at the start, then it's very difficult and sometimes often expensive to change things down the line. And that can be a bit of a problem. And so this is why I believe that particularly for PAYG individuals, what I mean by that is employee individuals, that investing is generally the single biggest area that will allow you to save tax and to cut your tax bill. And it's why I think it's so important to get this stuff right. Now, I got a couple of questions, guys, and thanks for those questions coming through. Wojak says, can I send money to my partner's account for trading crypto and stocks as they are not currently earning? What are the tax or legal implications of that? Look, that's a really good question. And I actually get this question quite a bit. So when you're in a couple, and particularly when you've got one person on a higher income and a higher tax rate and one person on a lower income and lower tax rate, it's really common and completely within the ATO's rules. And this is not tax advice, by the way. You should, of course, seek that out with your licensed tax professional. But it's completely within the rules to direct the investments to an account in your partner's name and manage take advantage of the lower tax rate that they have. Super common strategy. That's just called tax planning. No issues there. Now, in terms of the legal implications, that's probably something that's worth getting legal advice on. But generally, my experience with the legalities of that, and I think in terms of having a level of protection there against things like relationship breakdown and those sorts of things as one legal implication, that generally if you've got assets of the couple, that they tend to the courts, if there is a relationship breakdown and a financial separation, that they typically look at all of the assets regardless of whose name those assets are in as well. There are some control issues, and so I think if you have specific questions or concerns, it's worth asking a legal person about that. But yeah, I hope that helps, Wojak. One here from Sabesh says, tax for companies is lower, but you need to get it out sometime and then it will be taxed at your marginal tax rate. That's right. And guys, I can see, just before I get into that one, I can see a few questions coming through in the chat. It is a bit hard to keep up with them in the chat because of how that chat works. So if you've got a question and you want to make sure it gets answered, please just pop it into the Q&A box rather than directly into the chat. And I'm going to do my best to answer as many of those as I can. So Sabesh says if you're investing in a company, you need to get the money out at some point, and that's 100% correct. What a lot of people do with investment companies is that they'll use a trust with an investment company. So they put a bunch of money into their trust. That's where they do their investing. Then the trust needs to distribute money. They're already earning a high income, so they don't want to distribute it to themselves and pay tax. Plus, they don't need the money and they want to get it reinvested. So they distribute into an investment company. Over time, what's going to happen is that the company grows. It builds up like say a nice share portfolio, for example. And then at some point, the person's going to wind back on their employment income. And at that time, you can simply start paying yourself a salary from the investment company. Now, what happens, because the money's grown inside the investment company and the company's already paid a bunch of tax on that money and there's franking credits that get in there or whatever, that you actually are able to claim the tax credits that the company has already paid on that income. And so the income, it's already had tax paid, a company tax rate of 30-odd%. So often when you take money out of the company, if that's your only income, there's very little tax to pay. And in some cases, particularly if you've got all Australian shares that are all paying franked dividends, you can actually take money out and get a tax refund, meaning no tax bill, but you're getting a cash refund from the ATO. So very smart question, but yeah, it's something that can definitely be managed in a way that is quite effective as well. Vivian says, who is the best person to talk to about structuring things? Is it a tax accountant or a financial advisor? That's a great question. I'm sure I've got this on another slide, but just because you've asked, accountants are typically the ones that will set up the structures for you. They will typically set up trust structures and do bits and pieces like that. But if you're wanting to look at what is the right sort of combination of entities, and you're looking at what's your financial plan? Here's my income, here's my expenses, this is what's left over, these are the assets that I've got. How do I really optimize things from a tax perspective? It's only really through financial advice that you're going to get someone that's going to help you explore, well, if you did a trust or a company or an investment bond or a combination of those or none of those, this is how things would look, and really map that into your lifestyle as well. So you can see, okay, sure, it's going to save you tax this year, but what about next year? What about the year after? What about, you're going to have another kid in, a few years' time, and then that's going to impact things. And how does that fit in with the plan and those sorts of things? Legally, accountants aren't allowed to do that sort of advice, and practically they don't do that sort of advice. So if you're looking at that piece, it's probably more the financial plan side. So I hope that helps, Vipin. I might just take one more question, and guys, I really appreciate your questions coming through, and definitely keep those coming. I might just take one, and in fact, there's so many. I'll take two, and then I'm going to move on because I don't want to run over time as well. Norm says, what is the threshold in terms of income level where the PTY provides a lower tax environment than a personal tax rate? That's a good question, Norm, and I'm sure there's something that you could crunch in a spreadsheet, but what I would say is that typically where a company makes sense is when you're already earning an income. And so if your personal tax rate is above 30% or at 30%, then a company is going to be paying mean that you're paying less, the same or less tax. If your income is high, then it's significantly less tax. And so if you're thinking about, you're earning, say, 100 grand and you're on a 32% tax bracket and the company tax rate is 30%, then there's going to be a really small saving. But if you're going to crank up some investments inside either a company or your own name over time, if you don't do it through a company or some other sort of tax structure, you're quickly going to end up on 120, 150, 190, 200, and then you're going to be right into the top tax bracket as well. And so if you're looking at that number, sure, look at it right now, but you also want to be looking ahead a little bit to see how are things going to change as well. Last one from Stephen, actually on this slide, and then I'm going to move on. And guys, keep those questions coming through. Why is PAYG investing the biggest area to save tax? Great question. Look, so for employee individuals, then there's only really, you can do things like tax strategies, right? Negative gearing, debt recycling, super contributions. If you did all of those things to an extreme amount, then there's 10 grand, 20 grand, 30 grand or more of tax savings that are available. But if you're looking to replace, that the average income across Australia, ABS average income is like 100 grand. That means that if you want to replace that sort of income, that's at $2 million you're going to need to have in investments. When you get the structuring of those investments right, that has the potential to save you hundreds of thousands of dollars of tax over time, and upwards of 50 grand a year every single year. And so the opportunity is bigger, and it's certainly a lot bigger excuse me, than just buying a few extra deductions and getting a little bit more back in your tax refund by some cheeky deductions in your tax return or whatever. So yeah, that's a good question. I hope that helps. All right, so I'm going to move on, guys. Keep those questions coming through, though. The next section, I want to talk about how the tax strategies that you can use to actually cut your tax bill. Now, the first one that's important is about understanding your deductions, what you can tax deduct based on your occupation, industry, situation or whatever. Now, a lot of people miss out on claiming tax deductions simply because they don't know what they can claim. The ATO have some really quite helpful content on their website where you can get into that based on specific occupations to really understand those deductions. And that's a really important first step. Also, you want to understand the deductions that are available for the different tax strategies that are out there, which I'm going to come to in a sec. The next part is that you need to make sure that you're keeping good records, because if you've got tax deductible expenses and you're not keeping good records, you're going to not be able to claim things. And a lot of people, again, miss out on getting as much back in their tax return as they should simply because they don't keep the records, whether that's the receipts for your purchases, car logbook, motor vehicle, travel expenses, work from home, whatever those things are. They don't keep the records, and then you can't claim them if that's the case. The next one is around advice and education, cost of tax advice, cost of investment advice, cost of financial advice as well, depending on the type of financial advice, if you're getting that as well. that's a big area where you can cut your tax and get some tax deductions to get more back in your refund at the same time. The other part is around education and giving yourself the education so that you can grow your career and grow your income and grow your investment knowledge as well. So using things that professional study for your work, or even coaching, training, development, or learning about taking on knowledge, buying books about finances and these sorts of things. These are all can give you potentially significant tax deductions that again give you more back in your tax refund, mean that you can redeploy that to grow your money a bit faster as well. The next one, and something pretty relevant given the Sharesight crew on the line today, selling investments at a loss, having a really clear line of sight on what's going on in your investment portfolio, because when an investment starts losing money, that sucks. No one really enjoys that, but you can actually use that as something that can make you money if you're aware of it. Now, a lot of people will blindly hold on to their dog investments. I know that I am definitely guilty of this in the past. You get an underperforming investment, you're still hopeful that they'll finally turn things around and get back to where they were. But clearing out those investments can actually create a loss that you can use to offset other gains and reduce your overall level of tax. So it's something that's really important before the end of the financial year. You want to make sure that you're checking in on your portfolio, understanding your tax position, what the gains are that you may have realized throughout the year, what the losses might be, and what you've got in unrealized gains and losses, and optimizing your situation there as well. Again, having good tools, and for anyone again that's not familiar with the Sharesight stuff, they do some amazing work in this space, so definitely worth taking a look at. Next one is private health insurance, and specifically private hospital cover. If you don't have private hospital cover and you earn over a certain level, you get stung with an extra, that's called the Medicare levy surcharge tax, can be up to 1.5% of your income, which, when you're above the threshold, it's like, you're talking about, $1,000, couple of $1,000s a year, which can sometimes be more than the cost of the health insurance itself. And definitely if you're on a higher income, then you want to make sure that you're across this stuff, because the tax can be really prohibitive as well. Now, getting into tax strategies and the key tax strategies that you need to be across, then I'm going to jump back into a few questions. The first one, and this is not a specific tax strategy itself, but when it comes to planning your tax strategies and planning your tax more broadly, July and April are the key months that you should be looking to plan, in my opinion. July, because not for last financial year, July is the right time to be planning for the financial year ahead. Because if you wait until June or even May to do your tax planning before the end of the financial year, it can be too late to change anything meaningful. If you're wanting to, for example, and maybe this is a bad example, but max out your super contributions, you might struggle to put in 20 grand into your super fund over a course of one or 2 months. But if you spread that out over the course of a year, suddenly it becomes a lot more manageable. Similarly, if you purchase an investment property in June, it's not going to make that much of a difference on your tax position for that financial year, because you've only got 1 month of your deductions that relate to that. Whereas if you're planning in July, you do it at the start of the financial year, you've got more time, you get more deductions, you cut your tax bill further. And then April is in there because that gives you enough time to just tidy things up before the end of the financial year. That's where you look at, investments at a loss, whatever the things are that are happening there, to allow you to make sure that everything's sweet before the end of the financial year. Now, the next one that I've got in here is franking credits. And I think a lot of people have an awareness of franking credits, but most people I speak to don't realize how powerful they can be. Now, for anyone that's not familiar with this term, essentially what it is that when you're investing into shares, you're essentially buying a tiny little slice of a company. Now, just for example, let's use Commonwealth Bank. If you buy a share in Commonwealth Bank, you're buying like this tiny little sliver of Commonwealth Bank, 0.00001% of CBA. When you own that tiny little slice of CBA, when CBA makes profits, they generate revenue, they pay some expenses, they get left with a profit, they pay tax on that profit, and then they've got profit after tax. They keep some of that profit after tax to reinvest and grow their business, and you benefit because the share price grows as a result of them doing that. And part of it they pay out to their investors in the form of dividends. Now, because when those dividends are paid out to their investors, they're paid out from their profit after tax. It means that when you receive the dividend, you also receive a little tax credit that says that there's a certain amount of money in tax is being paid on this dividend. Now, those tax credits can reduce and offset the tax that you would pay on your investment income, on your dividend income. But they can also, if you get enough of them, that they can offset the income tax that you would pay on your other income as well. So really, really powerful. Further, and going back to the tax structuring, the entity structuring stuff that we were talking about earlier, that if you're investing in an investment company and you're using Australian shares that have franking credits attached to them, most of the time those franking credits are close to the company tax rate of 30%. And because the tax rate on your investment company is also 30%, it can allow your portfolio to actually grow inside of the investment company without you paying any additional tax, any top-up tax on top. That gets a little bit complicated, so don't worry if some of that went over your head. But what I mean is that with franking credits, you're basically getting a higher after-tax income from the money. And really, it's the after-tax income is the only income that really matters. The next one, negative gearing, one of my favorite strategies. It's where gearing just means borrowing to invest. You can borrow to invest into shares, but the most common way that people borrow to invest in Australia is into property. When you borrow to invest to buy a property, most of the time, particularly if you're using like a standard sort of 10 or 20% deposit, your property is going to be negatively geared. That means that the cost of the mortgage payments and all of the property costs are more than the rental income that you receive on the property, that the cash flow is negative. And that means that you will obviously need to fund that. But with negative gearing, you can claim a tax deduction for the interest costs and all of the property costs there as well. Now, that can reduce the income, reduce the tax that you pay on your income from other sources as well. So really powerful. But in my opinion, the tax benefits that you get from negative gearing are really just the icing on the cake, because the real benefit that you get from gearing is simply on the borrowing to invest side. You can buy 100 grand in savings with $500,000 from the bank, and all of a sudden you've got a $600,000 asset rather than a $100,000 asset. And an asset that's 6 times the size is generally going to win if you've got a good property versus a good share portfolio, because it's 6 times bigger. It's going to be really, really hard for the share portfolio to keep up. Next one is debt recycling. Debt recycling is a strategy that's specific for people that own their own home that they live in. And for those people, when you own your own home, you don't get any tax deductions for the mortgage interest costs on that property. But with debt recycling, how the strategy works is that you're able to convert that non-tax deductible debt into tax deductible investment debt and essentially pay down your bad debt faster and build a share portfolio at the same time. So essentially how it works, and this is a complex strategy, and this is something that if you're wanting to explore, you should definitely get some advice on. But say you've got a mortgage of, let's just say $500,000. And if you had $500,000 sitting in the bank, you could get $499,999 and pay it into your mortgage, pay it all the way down so there was only $1 owing. And then you could redraw the money. And if you redrew that money and put it into investments like share investments, for example, that because the purpose of you redrawing and essentially borrowing the money was to invest, then it makes all of the interest costs on that debt tax deductible. And we're talking $500,000, 6% mortgage interest rate. That's like $30,000 a year in tax deductions that you can be getting, and you pay off your own home bad debt non-deductible mortgage, and you end up with a $500,000 investment portfolio. So it's a really powerful strategy to, as I say, convert non-tax deductible debt into really tax effective debt and build some investments and an investment income at the same time. It is complex though, so if you're going to go down this path, and I've seen a few people that have tried to DIY and got it pretty seriously wrong, so it's probably not the sort of thing that you want to do without getting some good advice and support on. Last one is super contributions. And look, this is not a really exciting strategy, but every person can put $30,000 a year into their super fund and claim a tax deduction for that money. Now, that $30,000 limit includes the money that you put into your super from your employer through the compulsory employer super contributions. But for most people, that leaves a pretty significant room for you to put in some chunky dollars and get some pretty chunky tax deductions as well. And so money, keep in mind that money you put into super is locked in there until you're old and until you can take the money out. And unfortunately, the government does have a really nasty tendency to muck around with the super rules, but it can create some significant tax deductions. Plus, when you get money into super, the maximum tax rate inside your super fund is like 15%, meaning that the money can grow a lot faster in there as well. And so those tax strategies are probably the key things that you need to know. And they're all there essentially as tools. Each of them have different trade-offs, different merits, and they're good at different times. But most likely that you want to figure out the right combination of these things and the right timing of these things that fit in with what's going on with your investing plan, what's going on with your lifestyle plan, and make sure that it all fits together, because ultimately the right move done at the wrong time is the wrong move. And so you want to make sure that you got the right things, but you're also doing them at the right time too. Now, guys, I'm sort of looking at the clock here, so I might just crack on into the next section, and I can see those questions. Keep those coming through. I'm going to circle back. I'm going to circle back on them at the end. So, myths and mistakes. The next thing I wanted to cover, and basically go through some of the common ones that I see. The first one is around staying in a lower tax bracket. I see a lot of people that, as their incomes are increasing, they start stressing out, thinking that if they get pushed into the next tax bracket, that they're going to end up with less money in their take-home pay. But there is no point on the tax scales because of how the marginal tax rate works and the fact that the higher tax rates only apply on the income earned above the threshold. There's no point where you earn less money by having a higher income. HEX is one exception to that, where if you've got a HEX bill because of the repayment sort of thresholds or whatever, if your income goes up, you can end up a little bit more, but you are also paying down your debt faster as well. Offset versus redraw. This is another really common one. There's a big difference in the eyes of the ATO in putting money in an offset and taking it out versus putting it in a redraw and taking it out. And where we see this catch a lot of people out, people that buy their first home, they think that they're doing the right thing by paying down their mortgage and actually paying it, and then they've got it available in redraw. And then a few years down the track, they want to upgrade their property. So they redraw the funds out and use that to purchase the new home, use it as a deposit for the new home, and then they borrow the rest of the money for the new home. But what happens in that case, because, let's just say, for example, you paid down 200 grand of your mortgage and you redrew it out as a deposit, that $200,000 is, even if you turn the first property into an investment property, which a lot of people commonly do, because the purpose of you drawing out that 200 grand was to put a deposit on your own home, that means that none of the interest costs on that part of the debt are tax deductible. So what happens in that case is that you've got an investment property with really low debt, which is tax deductible, and then you've got your own home with much higher debt levels, which is not tax deductible. You sort of want to go the other way around. And so with an offset account, you can save money in an offset. It offsets the mortgage interest, meaning that if you got $500,000 loan and $500,000 in an offset account, you're not paying any interest costs on that mortgage. But if you take that, say, $500,000 out and use that as a deposit on a property, well, your loan was always sitting at $500,000. And if that property is used then as an investment property, it means that all of the interest on the full $500,000 remains tax deductible. So it can be really costly, like 10, 20 grand a year, pretty easily, depending on how much you can pay down your mortgage. It's a really weird rule, in my opinion, but it is how the ATO look at it. And so it's one that you definitely want to get right. Not tax planning before investing is another really common one. People wait until they've built up this real momentum or they get to this real critical mass in their investing and then start going, oh, I want to be smarter with tax. But as I said at the start, it can be a little bit difficult and a little bit expensive to change things if you get that far down the line. And so you want to do that tax planning at the front end. Also, you want to make sure that you're getting advice that doesn't have an agenda attached to it as well. And where I see this happen a little bit, and look, I know that there are a ton of really great accountants out there, but sometimes I've seen for some people that accountants, because they get paid when they set up trusts and companies, they tend to look at them a little bit more favorably sometimes, and sometimes can be a little bit sort of gun trigger happy, I suppose, with these things. Now, I love those tax entities. You might have seen the excitement in my eyes when I was talking about them at the start, and there can be some really cool strategies that you can do using trusts and companies and bonds and all of these things. But you should never have any of those tax entities if the benefit that you're getting from them, it doesn't exceed the cost that you've got of setting them up and managing them and all of those sorts of things. So you want to make sure, if you're thinking about going down that path, maybe get a second opinion, maybe get someone that's a little bit more objective to help you with your strategy. And then that way you're going to make sure that you're getting the right advice and not ending up with something that you don't need or that's got a really marginal benefit, but a few, admin headaches for you as well. Alrighty, guys. So look, I can see that there's a ton of questions. I'm going to crack through that in a sec. I just want to share this model with you guys about getting from where you are today to future state with your money. Now, reality is that for every single one of the hundreds of you guys watching in today, that in the future, you're going to be somewhere on the spectrum with your money. Some of you are going to be doing really well, some doing not so well, and a bunch of people in the middle. Now, a lot of people think when they think about getting from where they are to future state with their money, they think about that like a straight line. But because of the compounding impact of time and money, it's actually a curve. And so for a lot of people, like if you're not tracking exactly from where today to exactly where you want to be, there's some things that you need to do to what we call jump the line. That means that you might need to be, cut that tax bill down a little bit, optimize those tax strategies, use the right tax entities, crank up your savings investment rate, pay down a bit of debt, whatever those things are. So you need to jump the line. Once you do that and you get on track, then you just need to stay on track and just take the next step and the next step and the next step, which is easier because you're already on the path. But what happens is the longer that you leave it, the more time goes on, you can see is that the jumping the line piece becomes more and more difficult. The gap becomes bigger. And that's because when you got less time, you have to make more sacrifice to get there. And sometimes putting yourself into the best position possible becomes impossible. Now, for every single one of you guys, if financial success or financial freedom or whatever to you is, $1,000 a month of investment income, $10,000 a month, or $100,000 a month, reality is that you need to do a certain amount of stuff if you start right now today. If you wait a month, 6 months, a year, 6 years, all that means is that you need to do more, sacrifice more, take on more risk than to get into the same position, or you need to settle on the position that you're going to end up in. And so this is my motivational pep talk to say the sooner you get started, the easier it is, the less you have to sacrifice and the less you have to do as well. And so I wanted to share this quote from Derek Sivers, who's an absolute legend. He says, if information was the answer, we'd all be billionaires with perfect abs. So look, I hope you guys have got a bunch of great ideas off the back of today, but know that ideas without action are meaningless. So the power of an idea is in its implementation. So a lot of people want to cut their tax bill. A lot of people talk about cutting their tax bill. A lot of people whinge about paying too much tax. But there's not a lot of people that truly optimize their situation. So I suppose my words to you of encouragement off the back of today is to, do something about it. Make an appointment with yourself, make an appointment with someone else. Make sure you work through this stuff to actually take action. Now, guys, this is also what we do as well. And I'm going to come into these questions in a sec. I'm appreciating all the love coming through as well. One thing I'll just leave you with, like from our perspective, it's not like we're special and have access to some super secret black magic or anything like that. We just got a system that works when it comes to, how you cut tax, how you nail it with your money more broadly, and that can be done with anyone. Now, this stuff works. In the last 10 years, we've helped our clients build over $1.5 billion in wealth as a result of doing that. And this is the stuff that you can do if you follow the right approach. Now, as I said, this is what we do to help people as well. So if you need a push in the right direction, two ways that we help people: one-on-one financial advice, and our Smart Money Accelerator, which is our digital financial advice product. Basically, the financial advice, for anyone that's not already familiar or hasn't gone down this path, it's essentially where you work with someone one-on-one to build out a plan, and it's essentially done for you. This is ideal for people if you're saving $2,000 a month or more, and you've got some money that you can direct to investments and get actually working for you. The digital advice solution, Smart Money Accelerator, is great when you're looking to build up to that $2,000 a month as well. And so, look, I'll put some links on the screen here as well, and into the chat box. I'm going to chat through these questions that you guys have put in here as well. But look, if we can help, you know where we live. And as I said, for next steps around the tax planning, we've got our event partners here, Sharesight, talked a bunch about some of the practical applications that you get out of, understanding your tax position faster, looking at their stuff, and in particular their the paid plans, which have the extra reporting attached to them as well. Stuff is super powerful and can really help with this as well. Alrighty, so I got let me get into these questions. About changing could be expensive. We might have started investing without a proper structure. Now we feel like we should change our portfolio strategy, but we're scared about tax implications, i.e. paying more tax if selling shares. Is it possible that not changing strategy could be a better option sometimes, or not really, and it's always better to change strategy, and the earlier the better? Yeah, that makes a lot of sense. I think it can be. Most of the time, it is going to be better to change. That occasionally, though, that you can sort of transition and go between two worlds, where it's like you might want to invest through an entity, but then you've got some stuff personally, and it might take a while to manage out the gains or the tax that's on them. The first step is understanding the options. So it sounds like it would be worth you looking into that. And then from there, you can actually make an informed decision, because it's not as much as going, oh, yes, it's good, or yes, you should do something else. You want to make sure that you've got the actual numbers that you're working with. So I hope that helps, Gianluca. Thanks for this question. Thanks for educating me about debt recycling, which I'm about to implement on my $1 million mortgage. Boom, love that. I'm in the highest tax bracket, so I'm worried about my taxable income going up when I set an investment account with my husband and purchase ETFs, etc. However, if we purchase in a different tax entity, i.e. our trust, we can't personally benefit from tax deductions or interest payments. Your thoughts, please. Thanks. Look, it's a good question. Obviously, this is not advice, and you should seek that out. Probably similarly to the last question as well. If you're doing $1 million debt recycling strategy, you should probably be getting some advice from someone that really understands this and has a lot of experience for people in similar situations, because there's a lot of different things that you could be looking at there as well. It does get quite complicated quite quickly, and you'd want to do it, depending on your position, in conjunction with an accountant. But I would say that a financial advisor is the one that's going to be best placed to help with that as well. Yeah, there are a few different tactics that you can use. Property strategies, equity, using it, debt recycling into property is one of them, and a few other pieces as well. But it's another one where you want to understand the numbers, tax implications, what the timelines are to make the right decision there. So sorry, I can't be more specific on that, but I hope that's helpful. What about funds in investment offset any advantage? I think you mean holding funds in an investment property mortgage. Um, and yeah, look, if you don't have a non-tax deductible mortgage, and again, this is not advice and you should seek it out, but if you don't have a non-tax deductible mortgage and you're wanting to hold money in cash, then typically, an investment property mortgage is going to give you a higher return than what you would get from a high interest account. Because if you've got, say, a 6% mortgage, investment property mortgage, which is maybe 4% after tax because it's tax deductible, and you've got money in there, or you can invest in a high interest savings account, which is getting you 4%, which is then tax. Your after tax return on the savings account is like 2%. So you're talking about 4% versus 2%. So I hope that helps. But yeah, it can make sense. But if you've got a huge own home mortgage, then that's probably where you want to have your offset cash as well. Guys, I appreciate that some people probably have to drop off. I'm just going to stay on for a couple more minutes and see if I can crack through a few more of these questions. Den says, what is your fee range for one-on-one financial advice? So look, we've got a range of services that go from $90 a month to $9,000 a month. The right service depends on what sort of results you're looking for with your money. So it really sort of comes back to that. But that link that I've got on the screen is for a 15-minute chat with our team. And that's probably a conversation to give a little bit more context if you're thinking that sort of stuff is right for you as well. I hope that helps, Den. Ross says, at a high level, are there any downsides to debt recycling strategy apart from caution to DIY and added risk associated to the chosen investment? Um, Look, you are keeping higher debt levels is one downside. That if you just smash down your mortgage, your debt will actually reduce. Whereas if you smash into a debt recycling strategy, your total debt levels stay exactly the same. It's just you reduce your non-deductible debt and you increase your tax deductible debt. Um, and so, yeah, that would probably be one thing. But if you're already investing and you've already got a mortgage, that's probably the main thing, in my experience. It's a pretty cracking strategy in the right situation. Sorry, one other thing that actually is worth looking out for, you want to make sure that there's not a better option there for you as well. Because if you're using your property equity as part of a debt recycling strategy, um, that may, sort of consume your equity and could stop you, say, from buying an investment property, which may be even more beneficial for you financially down the track as well. So again, you want to sort of put that into your planning to make sure that you're really maximizing the overall results there as well. I'm just going to take one more question as well. And guys, I really appreciate all the questions coming through. Um, Marie says, do you prefer shares or property for investing? I have property portfolio already and want to continue investing in it, but some say to invest in shares to diversify, but the leverage I get in property is far better. Yeah, look, there's really two clear phases in what happens with your money, in my opinion, Marie. You've got the phase where you're growing your assets, and when you're growing your assets and building your wealth, then property tends to win because of exactly what you mentioned there in terms of the leverage. But when you get to the point where you're living from your assets, then the income return on property is about half the income return on a share portfolio. And that's because a lot of the return on property, the overall returns are about the same, but a lot of the return on property comes in terms of the growth. And so when yeah, depending on if you've got so much money that it doesn't matter, you can just have all your money in property and you're still going to have a ripping income. But if you're, really pushing to get to your true financial security level, you're generally going to get a better income if you've got that in money in shares rather than property. And so sometimes, and often, in fact, people will have a building phase, and then you want to transition to the living off your assets phase as well. Both have their merits. But you don't want to, diversify for the sake of diversifying. And I love the leverage as well. If you're hard into the building phase, then that's fine. I think shares are great though, and it's good to build your knowledge around them, particularly if you've got a bit going on the property side. But yeah, look, property is my favorite from a building perspective. So I hope that helps, Marie. Look, guys, once again, really appreciate all the questions. Stay tuned on your inbox. We'll ping you a note out. The Sharesight guys are going to push the recording of the session live as well. If anyone does want to learn more or have any product specific questions about Sharesight as well, you can just hit them up directly there too. And guys, upcoming events coming up. The next one's in just 4 weeks' time or so. Check those out. Would love to see you there. And guys, until then, stay safe and we'll catch you next time. Cheers, team. Bye for now.